Right now, something unusual is happening, something most people haven't really noticed yet. But behind the scenes, some major shifts are starting to take place in the global economy. Oil markets are getting volatile. Energy prices are moving fast. And governments around the world are trying to figure out how to respond. But here's the part that really makes you pause. In some parts of the world, the real physical price of oil appears to be much higher than the price you see on financial markets. At the same time, reports coming out of Asia show people lining up at gas stations, trying to fill up before prices go even higher. And if that wasn't enough, there are even discussions that some oil shipments might soon be traded not in US dollars, but in Chinese yuan. Now, if that shift actually happens, it could challenge a system that has supported the US dollar for more than 5 decades. And whenever the global financial system starts to shift like this, investors usually start paying attention to a few specific assets: gold, silver, and other hard commodities. So in this video, we're going to break down what's really happening in the oil market, why economists are suddenly warning about stagflation again, and why some analysts believe precious metals could play a major role in the years ahead. Let's start with the energy market. Because oil isn't just another commodity. It's the backbone of the global economy. Transportation depends on it. Manufacturing depends on it. Agriculture depends on it. Even electricity production in many countries depends on it. So when oil prices start rising quickly, the effects spread everywhere. Shipping becomes more expensive. Food prices start climbing. Air travel gets more costly. And inflation begins to move higher across the entire economy. Right now, geopolitical tensions and supply disruptions are putting serious pressure on global energy markets. And even if tensions cool down tomorrow, supply chains don't recover overnight. Shipping routes change. Insurance costs go up. Energy infrastructure can take months to repair. All of that creates uncertainty in the market. And uncertainty often leads to volatility. Another unusual development right now is the growing gap between paper oil prices and physical oil prices. Most people see oil prices through financial exchanges. Those prices come from futures contracts traded by investors. But the physical oil market works differently. Real shipments, real buyers, real supply and demand. And recently, some reports suggest that physical oil cargoes in certain regions are selling for significantly higher prices than what the exchanges show. When gaps like that appear, it can signal stress in the market. Now let's talk about Asia. Because Asia is one of the biggest energy-consuming regions in the world. Countries like China, India, Japan, and South Korea import massive amounts of oil every day. Recent reports suggest that drivers in parts of China have been lining up at gas stations before potential price increases. That doesn't necessarily mean there's a shortage, but it does show how quickly energy markets can become tense when people expect prices to rise. Now here's where things get even more interesting. For decades, most oil in the world has been traded in US dollars. This system is known as the petrodollar system. It started in the 1970s when oil-producing countries agreed to price oil in dollars. That meant any country that wanted to buy oil needed access to US currency, which helped keep global demand for the dollar extremely strong. But recently, some countries have started exploring alternatives, trading oil in different currencies, creating regional payment systems, or bypassing the dollar altogether. If energy trade gradually moves away from the dollar, it could slowly reshape the global financial system. And whenever large monetary shifts start happening, investors often turn to assets that aren't controlled by governments. That's where gold and silver come in. These metals have been used as stores of value for thousands of years. They can't be printed. They can't be created by central banks. And during periods of inflation or financial instability, they often attract strong demand. In fact, central banks themselves have been buying record amounts of gold in recent years. Another word that economists are starting to mention again is stagflation. Stagflation happens when economic growth slows down, but inflation keeps rising. That creates a very difficult situation for central banks. If they lower interest rates to support the economy, inflation could get worse. But if they raise rates to control inflation, they risk slowing the economy even further. The last time this happened on a large scale was during the 1970s energy crisis. And during that time, precious metals saw enormous price increases. Now, one final thing to keep in mind. During periods of financial stress, markets can behave in strange ways. Large funds sometimes sell assets simply because they need cash. not because they think those assets are weak. That's why even strong assets can drop temporarily during market turbulence. But historically, once the panic passes, markets can rebound very quickly. So here's the bottom line. The global economy is entering a period of major change. Energy markets are volatile, supply chains remain fragile, and conversations about global currencies and trade are becoming more serious. No one knows exactly how these events will unfold, but moments like this often reshape the financial system in ways that only become clear years later. And that's why investors around the world are watching energy, currencies, and commodities very closely right now. Because the decisions being made today could influence the global economy for decades to come.